Maybe, yes, get started. All right, good afternoon. Uh, we want to talk about more things about forensics or fraud tonight, and we're going to, rather than take my word for it, we're going to watch a series of short movies and have discussion. So there'll be a fair amount of video and discussion afterwards. And what I want to do for each video as we look at it, I want three of you to kind of say what were the top walkaways from your point of view of that information that we saw in that video. A lot of this is about how financial statements are misstated, meaning they're lied about, cause of failure in some cases of some public companies that we know about. So we're going to take a look at that, and the format we'll use, I will start with, like we always do in the back with Jake, we always pick on Jake. You're always the first one here and the first one to read, and often you're the first one to hand in your homework. Eric is got a heater problem with their landlord, and he's trying to negotiate through that, said he'd be late, said he'd be here. So hopefully that will be successful for him. The format we'll take is each video that we watch, the person will have each one of you take a turn at being in charge of reporting your thoughts from that video, and I would like you to converse with the person that's next to you in that direction. So when we get the last person, they'll report back to Jake. And kind of between the two of you, just take a minute or two after the video. What were the one or two walkaways from your perspective of the information that we learned? And then I'll talk about it a little bit as well. We also are going to talk about the DuPont analysis of where we're at with things, and we have some financial statements with Wilding's competitor, one of Wilding's competitors, and we'll talk a little bit about that and kind of what we want to do next and what I would like to do next regarding that analysis. Some very interesting things that are there. I'll show you that. Talk a little bit for a second about the Parade of Homes. Also talk a little bit about where you were at with your Investopedia simulator today. The market was a little tough today, and some of you did okay today, and some took a little bit of a hit today. The inflation reports were released this morning, and there was pretty active selling off by this afternoon on a lot of stocks all the way across the Dow. The top stocks that are in the Dow. The only one that made money today was Home Depot. All the rest of the sectors took a slide based on really skepticism about what our economy is doing. Really, are the Feds going to continue to tighten money or not? And as we look at the impact on the public markets, we're going to take a look at some interesting things on the private market. Like I said, today the St. George area Parade of Homes opened. The VIP component was today. It opens to the public tomorrow, and it runs through this weekend through the next weekend. I don't know if you've ever attended a Parade of Homes before or part of it. It's an interesting annual event that draws 40 or 50,000 people down from Salt Lake to spend the weekend in the sun. It snowed yesterday hard in Beaver, right, where I got tangled up, and north, and so it's kind of February still, right? It's still snow season for the resorts, and we kind of forget about that here. But the people that live up north welcome the Parade of Homes, and they come down and look at it. Some people buy homes. We have a lot of second homes in St. George that are owned by predominantly people in northern Utah. Now there's other places that people come from, of course, but for the second homes, the majority of the second homes seem to be northern Utah, followed by Idaho and Canada, and then Montana is kind of the order of the guests of second homes in this area that we have, and that's a good shot in our economic arm here in the county. We led the nation again with the top-selling luxury homes of any market anywhere for second homes. We had the most number of sales last year. Now, as we look, so we're going to spend a moment talking about the impact of inflation on our market. We're looking at the Parade of Homes, I think, is 31 houses this year. That may be not quite right, but I think it is. And one of them is submitted by the Washington County School District. And in my mind, it's the only affordable one. It's $500,000. And I don't know if that's affordable to everybody or not, but that's the one house that is priced at that range. Of the 31 houses, 27 of them are over $1 million and all the way up to $6.5 million. And so we're going to take a quick look at that, and we're going to talk about the speculation market and the real estate market here, because that impacts all of us, not just the high-end sales, but the high-end sales impact regular sales. And the state of real estate in St. George has been wild and crazy for a while, and there's a question about what it might be going into the balance of this year, for me anyway, into the balance of this year. And we'll look at that a little bit. We'll take just a minute and kind of go through the homes that are being offered, and we'll talk about one aspect or two aspects of them for a few minutes in class. So we'll take some time between other videos, and we'll talk about where you're at with Investopedia. We'll talk about the DuPont analysis for the competitor for Wildling, and we'll talk about the Parade of Homes. So we'll scatter that in between the videos that we're going to watch. So we'll start out, we're going to be looking, most of what we talk about today is going to have to do with fraud and misstating financial statements. And these will be little 5 or 10 minute video clips. Some of them, a fair number of them, by one of the guys that we've been listening to a little bit. He doesn't write so sharply on the board, and some of his financial numbers that he puts up there are a little fuzzy. But the content of what he's talking about is something that's of value to us from a perspective of looking at another company. But of course, we're not doing that all day, every day. But we will have an opportunity to help impact our company, the temptations that we have in reporting our financials. We want to always take the picture with, the warts on this side of my face away from the camera kind of thing, right? We want to take our best picture possible, and the balance sheet's a picture, right? So one of the things that companies always do is take the best picture possible. And sometimes, as we saw with Enron at last class, Enron wound up lying about their income. Not once, not twice, but for several years. And the people that masterminded that lie, remember what they did is they misstated financials under a contract. If they had a contract that they invested and it was going to have future returns, they reported those future returns now, which was awesome for their financials. Their financial statements looked great. Their stock price is going up because they're showing this solidness in it as a company. But it turns out people were buying their stock because their stock price was going up. People go, I got to get on that train. And they didn't do the research and figure out what was going on. And ultimately, the house of cards collapsed in about a 60-day period, and people went to prison. And so that happened in 2001. And remember, there was one aspect of Enron that was a surprise to most people, and that was one of the misstated revenues that they had was based on their contract with Blockbuster Video. Now, Enron was not a video company. In fact, they had no experience in video, none whatsoever. They had a contract to do, they were an energy company. They were the gas company in Houston, and they sold energy from various power sources, including wind and solar, but predominantly gas. And so that was their core business. And for them to announce revenue based on a deal with Blockbuster, that caught up with them. It turned out that deal never actually went through because it was too early technology. We weren't into streaming video yet. We were still renting things from Blockbuster, and Netflix didn't exist in 2000. And so when the revenue didn't follow, Blockbuster cut off the deal because Enron didn't have the ability to reach the distribution market that they claimed. All of a sudden, their financial statements started sagging fast, and people started looking at them and said, oh, this is about a bunch of hot air. And because it's a bunch of hot air, I want to sell. And everybody wanting to sell at the same time results in stocks plummeting, and they dropped down to 20 cents before they actually filed bankruptcy. And that was from $200. You know, that was a precipitous fall in the stock value. So we talked about that a little bit, and that kind of sets the stage because there's some others. They weren't the only ones. They were just one of the early ones. We'll talk about some other, and we'll look at some other and have some conversation about it. We'll look at WorldCom, Kraft Mac and Cheese, look at them, and a couple other companies that have gotten caught with some bad stuff. But at what point in time does us taking the best picture for our company, we call that aggressive reporting. When is that legal and when is it not legal? And how is it that we know how hard to push that on our own financial statements? And at what point in time is Zion Bank going to cry foul and alert the feds and say, I think there's some monkey business going on with this company? And I know of a couple of companies, and I think you might too, so I won't mention them because that's a fairly significant allegation when your banker cries foul and calls the feds to have them investigate your company who they have money loaned to. They want to stay squeaky clean. There was one bank that went down with that exact scenario, and that was the Jeremy Johnson related SunFirst Bank here in St. George. And when that bank collapsed, that was due to the feds blowing the whistle on several things. There were the indictments. That was public information. We all could read that, so we can talk about that. Whether you agreed with it or not doesn't matter. It happened, and it was printed. And so that had to do with a gambling website and cash reserves in a bank here in St. George, and a few other things regarding merchant accounts, hundreds of merchant accounts that were fraudulent. And so that bank went down, and it was the bank initially that called the feds to distance themselves from the problem. But as it all unwound, the CEO of the bank, John Campos, some of you know John, he works for Salisbury Homes as a salesperson now, but he spent 5 years in federal prison because of that debacle. And he's a nice guy. He was just caught in crossfire. And nice guys sometimes get caught in crossfire. He's not what I would call a criminal. He was the CEO, and the buck stops there. And so when the company does something shady, whoever's the financial king of that entity goes to prison. And in this case, it was John. And some other people took pretty hard swats, and Jeremy Johnson went to prison as well. But there were a fair number of indictments and a whole lot of sweating on the part of people here in town, people we know, our neighbors, people, some of these neighborhoods in the Parade of Home, one of them had at least 5 of those principals that were under fire, some of whom were guilty and some of whom were not. So these are people we know. This isn't far away. This is stuff that happens here in town. And be careful what you repeat. Make sure there's fact behind it, because that's a dangerous thing. Did I do something wrong, Gordon? You're just stealing our trash? You guys are sorting through trash. I know what's happening. All right, so let's take a look at fraud. And for right now, when this first video clip is over with, Jake will consult, and the two of you will have a little bit of a what's your number 1 and number 2 takeoffs, and then the next one will be Josh, and Josh and Callie will have a little conversation, and you'll tell us what your thoughts are. So there's a problem with my drive that was just open. A heck of a time for a problem with your drive, right? If it's a big problem, we'll be going home early. All right.
When a company engages in aggressive revenue recognition, It's recording a sale when it should not be recording a sale. And there's two main ways of doing this. One is to simply fabricate a sale, just to record a bogus sale that didn't actually take place. You're completely just making this up. Another way is to prematurely recognize a sale. This is a sale that's going to happen next quarter or next year, but you're moving it ahead and you're recognizing it right now. And so this video, I'm going to talk about prematurely recognizing revenue, and in the next video, I'm going to talk about bogus revenue. So let's get to work. So channel stuffing, this is a common phrase, you might have heard it. Channel stuffing, here's how this works. You've got a customer, and you tell them, you know what, you should really take some more vacuum cleaners. I think we're going to sell you some more vacuum cleaners. So they say, look, we have enough. Our warehouse is full of your vacuum cleaners. We really don't need any more. And you say, well, you know what, you should take some more. You should take some more vacuum cleaners. And I'll tell you what, if you don't sell the vacuum cleaners, like if you take them and you can't sell them, you can return them to us at no charge. And in fact, we'll pay the cost of return shipping. And the customer says, why are you doing this? Like, I don't even need any more vacuum cleaners. And they're like, please, just take the vacuum cleaners. We'll make it up to you later. We'll give you a discount, something like that. And basically, this company is trying to meet its quarterly sales target. And so they're just pushing this product on the customer, even though the customer is saying, look, I'm telling you, I'm going to return this stuff. I don't need it. Okay, so that's called channel stuffing. Now, so basically with channel stuffing, you are, if you can think about it, is you're stealing from a future period sales. Because what's going to happen next quarter? Normally, they would have sold through some of these vacuum cleaners and then reordered from you and said, okay, now we do need some vacuum cleaners. But you're making them so full of vacuum cleaners that they're not going to buy any from you next year. So you're taking sales from next year and you're moving them to right now. That's basically what you're doing with channel stuffing. Now, changing the date of the fiscal year end. Let's say that you have a company where the fiscal year end is December 29th usually. Okay, so that's a fiscal year end. But you move it and you change it when you're so that now it's December 30th, or let's say December 31st. So now you're getting an extra 2 days of sales in there. If you normally say, well, it's December 29th, we're going to change it. Well, this year it's December 31st. Because you went from December 29th of the prior year to now December 31st, you're getting that extra 2 days. And you said, like, well, what does it matter? Well, if the manager is being compensated based on hitting a sales target and they haven't hit the sales target, and that extra 2 days worth of sales is going to help them hit that target, then they would engage in this kind of dishonest behavior. Holding the fiscal year end open has to do with the following. So let's say, let me give an example. So let's say the fiscal year end is December 31st. Okay, and we said, look, at 11:59 p.m., December 31st, this is the cutoff time, right here. This is the cutoff time. Any sales that take place after this, so let's say it's like 12:15 a.m. on January 1st, that is not going to be included in for the fiscal year end December 31st, okay? Let's put some dates on this, by the way. Let's say December 31st, 2020, and then on January 1st, 2021 at like, let's say 2 a.m. If a sale takes place, okay, that would not normally be recorded for the fiscal year end December 31st, 2020, right? Because it is past the cutoff. It's like you're 2 hours late. Sorry, that's going to go in 2021 sales, okay? But if the dishonest manager says, well, you know, we're trying to hit our sales target, and at 11:59, we haven't hit the sales target yet. So guess what? We're going to hold the fiscal year open for maybe a couple more hours, maybe an entire day. They're going to pretend. And so when they write up the sales invoices and everything and the shipping documents, they're going to make it like it was shipped on December 31st, 2020, instead of what actually happened on January 1st. They're basically going to have to, make the shipping documents and stuff. They're going to have to basically falsify them to make it look like it was on December 31st. So this is another dishonest tactic. Now, again, you're stealing from the next period, because this normally, a sale at this time would have went in 2021 sales. But you took from 2021 sales to boost 2020 sales, okay? Which is, obviously, this is dishonest. But also now, in 2021, you're going to have less sales. So what are you going to do? You're going to have to do it again, right? At the end of 2021, you're going to have to steal from 2022, okay? So this is what can happen when you engage in this kind of dishonest behavior. Now, recording revenue before shipment, this is just, okay, we made a sale, we haven't even shipped it out, we haven't done anything here, we got the cash from the customer, maybe we did, maybe we didn't, but we have not shipped. Remember, normally when the product is shipped, that's normally when revenue has been recognized, right? The product is shipped out, and in some cases when the customer has actually received it. So if you've just got products sitting on a shelf and it has not been shipped, then you should not be recording a sale. Okay, generally speaking, you should not be recording a sale. So if you're recording revenue and you haven't even shipped it, that's way too aggressive, right? To wait till it's shipped. Now, shipping uncompleted products and assembling them elsewhere, I've heard of one company doing this. This is a really awful story. Basically, so they were selling products internationally. I forget what country they were selling to, so I'm just going to say that they were selling products to the Netherlands, to some customer in the Netherlands, and they did not have the product completely assembled. Obviously, the customer is going to want the product completely assembled, so they can't ship it to the customer in the Netherlands because the customer is going to be like, hey, what the heck, this isn't even assembled. So what they did was they rented a warehouse. They rented a warehouse in the Netherlands and shipped the product there. And then when it was fully assembled at the warehouse, then they give it to the customer in the Netherlands. So you say, well, why would they do that? They wanted to record the sale basically when they had shipped it to the warehouse and it wasn't fully assembled. They wanted to record the sale anyways, and they needed to be able to show the auditors some kind of shipping invoice saying, hey, we sent this product to the Netherlands. Now, of course, they're not going to tell the auditor, yeah, we just sent it to a warehouse. This isn't finalized. It still hasn't gone to the customer. They're going to make it out like, yeah, there's a customer in the Netherlands. We sent them the product. Everything's fine, right? When in reality, this product hasn't even been fully assembled yet. So again, this is a timing issue. There's an actual customer that wants the product here. This is not a fictitious sale. It's just that prematurely they're trying to recognize the revenue now, but they have not assembled the product and given it to the customer. So that's why they're playing this game. Okay. Now, recording revenue for a full shipment when you only have a partial shipment. So let's say that the customer says they want 18 widgets. Okay, and they say, we got 18 widgets, and you don't have 18 widgets. You don't have them. You only have 6. So you just send them 6, and you say, well, okay, and you put on the shipping invoice, or excuse me, the shipping documents and everything, you put 18 so you can recognize sale for the full 18 when you only have 6. Okay, so now what's going to happen? The customer's going to receive this and say, hey, what the heck's going on? I ordered 18 of these, and you only gave me 6. And you're going to say, oh, yeah, this is a mistake. Don't worry, we'll get you the other 12. Why, again, is the company doing this? They are trying to book revenue today for the full 18, even though they don't have 18 in stock. So this is a real economic transaction. There's a customer wanting 18, they just don't have 18. So they give them 6, but they book 18 as being shipped out today so they can record revenue for 18. Do you see the game that's being played here? Yeah, that's why it's premature revenue recognition. If they had just waited, then they could get revenue for the whole 18, but or just ship the 6 and then next period, when you ship the 12, recognize the revenue for that. But they're trying to book the revenue for all 18 right now, and so they're just sending out 6 and then, lying on the shipping documents. Okay. Now, announcing a price increase, that might not seem to you like premature revenue recognition. You might be like, what are you talking about? Like, companies increase their prices all the time. But so let's say it's December 31st, and that's your fiscal year end, and you're really trying to hit a sales target, and you're not quite there, but you're close. If you tell customers, hey, so let's say it's December 31st, 2020. If you say, hey, January 1st, 2021, our prices will be going up, right? Our prices are going to go up by 20%. What is that going to give customers an incentive to do? They're going to be like, well, I better order by December 31st, 2020. So stuff that they were normally going to order in 2021, that you're going to accelerate where they make the order now. So you're basically trying to get them sales that would normally take place in 2021. You're trying to get them to take place in 2020 so that you can meet your target. Now, what happens in 2021? Maybe you tell them, you know what? Hey, we were going to do a price increase, but we decided not to. So, or maybe you go ahead with the price increase. But either way, what you're trying to do is take sales from that would normally occur in 2021 and shift them into 2020 so that you can hit your sales target. Now, recognizing revenue up front for a long-term contract. Let's say that you have, let's say your company received $6 million to provide services to a company over a period of 2 years. Okay, and the company let's just say they pay you the whole $6 million up front, and then you recognize that $6 million immediately. That's not how it's supposed to work, because if you're providing services over a 2-year period, then you should be recognizing that $6 million of revenue over a 2-year period. It shouldn't all be booked immediately, but you'd be surprised by how many companies find a way where they basically book the $6 million immediately because they're trying to hit a sales target now. Or maybe they don't book the whole $6 million, but maybe $5 million when maybe it should have been $3 million for each year, and so there's all kinds of games that they play here, but it's a common thing where they got this money and they're supposed to be spreading it over time, but they try and prematurely recognize that revenue and book all $6 million of it today.
Okay, so that's an example of our first one that we want to talk about. Jake, you are the person in charge. Josh, maybe you guys could talk for a second or two and see what are the 1 or 2 things that were the big takeaways for you. Meanwhile, we're going to watch a second. Go ahead and have your conversation, and we're going to watch a second installment of this. But what we're seeing here is not a specific company's financial statement. We're talking about what could be done. Now, these are ideas for you if you want to falsify numbers. These are ways that you can do it. But it's also something your bank is looking at. And if they sense that you do any of those things, you may not go to prison in a private company for doing that. In fact, private companies get by with a lot of things a lot of times. But if your bank sees that you're doing that, that will erode their confidence in you completely. And once your bank's confidence is eroded, that makes it hard for you to raise the next round of capital that you want, or to get financing for a big order that you get to move forward. You want to keep that relationship, and you don't want them to think that you're trying to pull a fast one all the time. If someone is looking to buy into your company and they sense that you're doing these practices, most sophisticated investors will run 50. They won't have anything to do with that, because that implicates them if you actually get caught by the feds by misstating company financials. And the more public your company is, officially public, is there's a set of laws that you break, and you go to prison for that. If your company is a public looking company, then that erodes the public's confidence and support in your company. So we want to be aware of what could be done, and we want to make sure that we steer clear of that when we record our own financials. Some of these are tempting, and for public companies, you go, well, what's the big deal if you take it in December versus January? Well, some of the stocks that dropped in value today, that we saw erosion all across the Dow. Some of the stocks that dropped today were because they are admitting that they are not going to meet the projections that they have. Their sales are going to be lower, or their profits are going to be lower than they thought they were. And so that did drive their stock value down today. And it may recover in the future, but it may not. And so the investment community is sensitive to if we're going to miss our numbers. So that puts pressure on companies to make their numbers. So they're not reporting we're close, but we're not there. Well, Wall Street doesn't usually care how far off you are. You're off. You missed your numbers. And that's all they hear. I missed it by 0.1% isn't a lot, but you still missed your number. And when that gets published as a headline, then usually that will have consequences in the price of your stock and the confidence of the market. You guys ready?
Sure.
Okay.
Well, my takeaway from it is don't do it. Just report it how it's supposed to be reported. I really kind of found some amusement on the keeping the fiscal year open, and how it's very similar to how, don't kill me about this, but how the voting is here in America. So,
Yeah, keep the polls open.
He had asked kind of if I was familiar with like any of that, which I'm not. But we have a situation at Wilding where the customer pays for half the bed upon order, and then half the bed upon shipping and/or assembly or installation of their home. And so I would assume that half of it would be on, like, if you purchased the problem in 2022,
Yep. And that's problematic. I mean, and we have a fair number of examples where that's the case, where there's a temptation to take earnings before you actually get them. Transportation is an example. I used that already as an example. If you're Warren Buffett owns Burlington Northern Railroad, so they haul freight, they haul cars, and they get paid to haul cars from the car factories to dealerships in various states. And when is it correct to post that revenue? If you've got the order to pick up the cars, 3 rail cars full of automobiles, do you post it then? Do you post it when they're loaded on your train? Or do you post it when they're unloaded off of your train? And in some cases, you can stipulate when you post that sale, but you can't move it around. You have to stay consistent with how you post it. And if it's disclosed that that's what you're doing, that we have taken revenue for stuff that's not delivered yet, and your shareholders know that, and your customers know that, then perhaps you can do it legally. I would talk to your attorneys and talk to your accountants about how you're posting that. But that's definitely up in the air. Josh?
So are there laws on how long you can actually hold the fiscal day open or kind of thing?
Yeah.
He was talking about like holding it for hours, but is there like a limit of how long you can actually do it before it's like, all right, it's illegal to do that? Or-
It probably, everything would go to court, and it would be actually tried in a court of law where you could defend yourself. But technically, at the stroke of midnight of the end of your fiscal year, your books have to close. And that is relevant now, because think about how many orders Amazon.com gets between midnight and 1 a.m. That could be $500 million. I mean, if they're running a sale, Christmas sale or whatever, and they hold that open, that smacks of big enough money that it would be really prosecuted. And so to make it clean, when you say it's done, close it. Now, that doesn't mean that your bookkeepers have to have finished all of their paperwork and recording of entries and all of that stuff, but the books are closed as of that moment in time. So it's catching up with the paperwork, but not catching up with falsely recorded timestamps. And in local small businesses, it's very common for small companies here to hold their books open a week and a half after the end of the fiscal year, trying to get sales. Now, McDonald's won't do that because they're selling every day, and their numbers are going to be audited by McDonald's Corporation. So the franchisee is going to play by the rules that McDonald's Corp is playing by. But small companies here, a cabinet shop, wouldn't be hard at all for a cabinet shop to justify, we've been working on this order for a month. It's a kitchen in a high-end house, and we're gonna push that early. We're gonna post that sale before it actually completes. And builders do it. There's a question mark about at what point in time do you close on a house? If you close and there's a punch list remaining and there's a retention holdback on that, can you post the whole sale, or do you have to defer the retention holdback for when it actually, after it is approved? And legally, you have to do that way. You can only post the portion of the sale that was not held back for you to complete. Even though you may have technically finished the house, and technically they've signed the papers, and technically you've given them the key to the front door, if there's a to-do list that you have to finish before it's actually done, the bank will have held some money back. They didn't pay you. So if you post that as a sale, that's a problem. And so if you're a local builder, probably get by with it. If you're D.R. Horton, you won't get by with it. That's a public company. Their financials are audited. When I say you won't get by with it, who knows? They may lie long enough until they get caught. I don't think they're that kind of company. They're a public company, and you can invest in them and do a little research. You probably can have confidence in the way that company is posting their financials because they're regulated, and there's people looking at how they're doing it. All right, did you have anything to add?
Do fiscal years actually follow the actual year? Because you're saying just 12/31.
He used that as an example because most people do. I shouldn't say most. Many people use the year end as the actual fiscal year. So those two words are spelled differently if you didn't notice that ever. The physical year is PHYSICAL, and that's generally considered our calendar year. That's a physical year in our lives. We base that. But when you technically look at it, each of us has a fiscal year that's based on your birthday, right? In terms of that's when your day started or your life started was on your birthday. So we all have the idea of a fiscal year personally, but a fiscal year is spelled with an F, and it doesn't have a syllable in it. It's fiscal, two syllables, FISCAL, and we often abbreviate that as FY. So at this college, we are in FY23, but we started FY23 on July 1st of 2022. And we will start FY24 on July 1st of 2023. So we put a name for our fiscal year if our fiscal year starts anytime other than January 1st. If it starts January 1st, our fiscal year and our physical year are the same. And there's no real super advantage to one or the other. The federal government ends on September 30th. State contractors end on June 30, say state contracts end on June 30. So different entities have different fiscal years, and he was saying that you could play games with that.
Our personal day policy does that, July to June, because before it was end of year, we had a lot of people calling out at the end of the year to use their personal days. So that last 2 weeks of the year, while we're trying to get beds out to customers, everybody was gone.
That's interesting. So you made
So we changed it.
the human
Reset.
resources policy is based on a different fiscal year than your company's is, so that extra people taking days off doesn't ding your bookings for the year.
Yeah.
That makes a lot of sense to how the company is trying to compensate for, it's all also the holidays. So there's already a shorter number of hours to work
Right.
that last month of your year. So that's the where it gets, what he was talking about was sliding on the fiscal year. It was for forensic purposes, where you're doing it for fraudulent reasons. I did it with a company, a public company, at one point where I stretched and got a little extra time to report. When it was nearly the end of our true fiscal year, I restated a new fiscal year that was longer than 12 months out. So it bought us a little time. We were behind on our 10Qs. We hadn't written things up, and we hadn't reported to Wall Street. So the only way we could legally get around that, to buy some time, we still had to report factually what occurred, but figuring out how to say it and figuring out if you had a solution. We didn't have a solution when the deadline dates were. And so we needed some time to get an investor group to underwrite. The company had been stolen from, and it was a mess. And so to figure out how to clean up that mess without falsely reporting what was going on, we stretched the fiscal year by changing it. And that would be enough to put a red flag for a financial advisor, the Wall Street analysts that were looking at our stock. They flagged that, saying, we don't know why that happened, but they've stretched the year. All right, so it wasn't undisclosed, but nobody knew what our motive was because we weren't going to say. But we stayed by by Securities and Exchange Commission rules, so we stayed legal on that. The illegal part is if you're doing it to falsify your sales or profits or whatever you might want to move. Okay. Any other comments on that first one?
We experienced that with Sherwin-Williams.
Oh, you did.
Yeah. Well, just hearing about
Yeah.
his explanation of the partial fulfillment of orders.
Yep.
We would put an order in with Sherwin-Williams, and we would receive it. The invoice would state the entire order, but what we physically received would only be a half or 3/4, and there's
Yep.
no log of back-ordered items or anything like that, and they would bill us for the total amount of the order, and we would call them up and say, where's the rest of this stuff?
Yep.
Oh, we'll send it down on the next shipment.
Yep. That's for sure. shady practice.
Right.
Whether it was completely illegal or not, we need to know more information, but that sounds to me like an auditor would have a heyday with that. It's not okay, and that's a public company. So that would be something that needed to be looked at on the grassroots level. Yeah, interesting. All right, let's look at part 2, more ways to cheat.
Sometimes when a company engages in aggressive revenue recognition, it's just prematurely recognizing revenue that would have been recognized in the next year anyways, and they're just trying to recognize it in the current period. However, sometimes aggressive revenue recognition is just completely bogus sales or some situation where revenue should by all rights not be recognized either right now or in a future period at all. For example, if you have a company that ships product to a customer that the customer did not even order, and you say, well, why would a company even do this? Well, let's say you ship the product to the customer, so here's the customer C. Now, what you have is you have shipping documents that you can show your external auditor, hey, look, we made a $10 million sale, and look, here's the shipping documents, we sent it to the customer. And you might say, well, hey, wait a minute, this customer is just going to send this right back. Well, think about it, the customer's probably going to think this is a mistake. They're going to contact you and say, hey, we just got $10 million of product, and we didn't order this. And you say, okay, well, just send it back, mistakes happen, but when you receive it back, it's the next quarter. So you book that 10 million of sales for the current quarter, and the customer just thinks it's a mistake. Oh yeah, companies are sneaky like that. Now, shipping empty boxes to customers, that's actually happened. If you think this is crazy, what company would ever do that? There's a company called American Banknote Holographics, and they were shipping empty boxes to customers. They basically, the customers were getting upset, actually saying, hey, we get these boxes, and they're just like either completely empty or scraps. So they basically made holograms and stuff for money to help the government's create currency. And they were shipping empty boxes and sometimes boxes with just scrap materials to the customers. And just obviously it's very sketchy when the customer is receiving that and stuff. But again, what are they trying to do? They're trying to create some kind of paper trail. So when the external auditor comes in and does their audit, they can say, hey, look, we have shipping documents here. We actually shipped out boxes to the customers. But of course, the customers are going to be unhappy. They're like, look, you're actually literally sending us garbage. Please stop. But these have actually happened, these crazy scenarios. Now, relaxing the credit policy, you might think, okay, well, maybe that's just good business. Well, when it goes to its extreme, when you're giving credit to people who you know are not going to be able to pay, or there's extremely high risk, these people are not going to be able to pay. For example, there used to be a retailer called Grants. Okay, and Grants, the business was declining, and they basically started giving out credit to anybody with a heartbeat. Okay, so you had Grants, they were giving out credit, and then also there was a jewelry store called Friedman's, okay, that sold jewelry targeting low-income consumers, and they basically significantly relaxed their credit policy, and they weren't recognizing sufficient bad debt to basically acknowledge that, hey, most of these people aren't going to pay. And so those are a couple examples where the company's trying to boost sales. Remember, the company wants to increase revenue, right? So they want to increase revenue, and sometimes they will engage in behavior like just giving credit to anybody. That'll increase sales, right? If you run an ad and you say, listen, you walk in here, no money down, not going to check your credit, doesn't matter, you walk out of here with a washer and dryer that day. You want that deal? People will be like, yeah, I'll take that, right? You're increasing revenue, but is that really a sale? Now, when you recognize revenue when a product has been consigned, that is not right. That is not right. So here's what consignment is, by the way. So let's say you have a product and you haven't sold it to a customer. You shipped it to what's called a consignment company. Okay, so I'll just put C-O-N-S here. So a consignment company, and they're called the consignee, technically. Okay, so you send it to the consignee is going to sell it, and then they're going to get a portion of the proceeds. So if they sell it for $100, they might keep $30 of that, and you get the $70. So basically, this product, when you send it to the consignment company, it is not yet sold. It's still your property. It's just the consignment company is holding it and trying to sell it. So you can't recognize any revenue just because you gave it to the consignment company. Sometimes companies improperly do. They say, hey, look, we sent it out, it's gone, it's a sale, and it's like, no, it's not. Now, bill and hold sales, you should always, if you ever hear about a company with bill and hold sales, you should assume they're sketchy. So there are limited cases in which a company can legitimately recognize a bill and hold sale, but usually when you hear bill and hold, just think that this is sketchy. Bill and hold is, hey, we've got a sale where the customer wants it, wants this product, and it's a legit sale and everything, but they don't want the product yet. Maybe they don't have space for it, whatever. So we're going to bill them, and then we're just going to hold on to that inventory. So the inventory, remember, inventory is normally, the sale is recognized when you ship the product or the customer receives the product. If it's still sitting in your warehouse, generally you're not supposed to be recognizing a sale. So these bill and hold sales, like there was a company called Sunbeam. Okay, they were involved in a huge accounting fraud, and one of the things they did was bill and hold sales. They basically, it's like, it's not a real sale. Imagine if the warehouse burned down and you go to the customer and you say, all right, you got to pay for all that, and they're like, I'm not paying for that. I never even received it, right? So that's why bill and hold sales are a little bit sketchy. Now, recognizing revenue on sales of non-existent inventory, that is harder to do than you might think, because you not only have to fabricate a sale, you also have to fabricate that there was any inventory to begin with. And there have been plenty of companies, though, that have overstated and basically made up inventory that they did not have, like Farmore, for example. They had a big accounting fraud and went bankrupt and went under. So, you basically make up that you even have any inventory, and then you make up a fake sale. So you got fake inventory and a fake sale to go with it. Recognizing revenue when there's no commercial substance. Commercial substance, I'm talking about, like, there's really no economics happening here. For example, let's say I make video games. Okay, so I make video games, and I say, okay, I'm going to sell 1 million units to this distributor. Okay, to the distributor, I'm going to sell them 1 million games, but I have a side agreement with them. Okay, I have a side agreement with them where they're immediately going to buy 1 million games, or I'm going to buy those 1 million games back. So I have, quote, sold the 1 million games to the distributor. I have the sale, but I have a side agreement, which maybe I don't disclose, right? I don't put that out there in my 10K or let the auditors know about it, which is wrong, as I've said. Now that I'm going to immediately buy this back. Okay, so that, if you're booking a sale, you don't have a sale because you already have a side agreement to buy the inventory right back. So that's sketchy. You've had companies that they set up like a subsidiary and stuff, and the subsidiary, they're like making the sale, but then it's going to come right back with some kind of side agreement. So anytime you hear about undisclosed side agreements or some kind of transaction where you're like, is there any commercial substance? Is this a real sale? You should not. You should be very skeptical of that company's accounting.
We saw that actually happening with Sears and the Craftsman model as they were branching out and putting the Craftsman brand in other stores beside their own. The people that they were allowing to do that jumped at the chance because Craftsman was a strong brand for a minute. Well, since my dad's lifetime, it was a strong brand, and so those people agreed to the fraud based on they were having an opportunity to hold the brand name, and they knew the company was in a cash flow problem, and so if they accepted an invoice for a certain amount of product and the company agreed to buy it back, everybody knew there was a charade going on, but it was keeping the brand alive for a little longer for some hope. And so they got participants to go along with that. And that kind of completely unwound before it finally was over. And Sears was now gone to Kmart. And then, of course, that's part of what took Kmart down, was the backlash from those activities.
Grossing up revenue in some cases is a lot. So what I'm talking about with grossing up revenue, you've got like these online booking companies, okay, where you like book a hotel through them or something, and let's say that you end up paying them, let's say that you pay them $103, okay, for a night at a hotel. You pay them $103, but they're only getting, their revenue is really only $3. Okay, 100 of that is for the hotel. They only just take a $3 fee. So really, if you think about it economically, their revenue is $3, right? They made a $3 fee from that transaction. But what some of them will do is they'll recognize $103 of revenue and then subtract this 100 as cost of sales. So basically, this doesn't affect profitability, as you got 103 minus 100, or just recognizing 3. Either way, it's 3. So you'd say, well, why does it matter? Well, when they do it this way, then the top line revenue is going to be a lot larger. So it's making it look like, wow, look at all this revenue they had. And it's like, come on, really they collected a $3 fee. That's what happened here. Now, boomerang transactions. So I'll give an example of actual boomerang transaction. So there's this company called Global Crossing. Okay, they basically built a transatlantic fiber optic cable and stuff for internet traffic and other things. So they have this transatlantic cable, and they among other things they got into these boomerang transactions with companies like Qwest. Okay, and what they would say is, look, hey, we need to buy some capacity from you, Qwest. We need to buy some capacity, so we'll pay you $100 million. Okay, we'll pay you $100 million for some capacity. And then Qwest also is like, hey, well, you know what? It's a coincidence. We need $100 million of capacity from Global Crossing. So they each are saying they need $100 million of capacity. Now, the question is, are they really buying capacity from each other, or and this comes back to whether there's commercial substance. Okay, this comes back to whether there's commercial substance here. This is really a transaction that may not have commercial substance. If you could show, look, no, actually they really need 100 million capacity, and so did Qwest, and this is a legitimate transaction. But what happened? Here's what Global Crossing did. So they recognized $100 million of revenue from this. They said, oh, look, Qwest gave us $100 million of revenue. But when it came to the amount that they paid Qwest, what they did was they capitalized that. Okay, so they made it an asset and depreciated it over time. So I don't know how many years they spread it over, but let's say they spread the 100 million over 25 years. Okay, let's say they spread it over 25 years. So then in the first year of the agreement, they have booked 100 million of revenue right now, but then they only take 4 million of expense right now. So in the current period, they recognize $96 million of profit, when in reality, it's like, look, this was a capacity swap. You got 100 million, they got 100 million, and maybe there was a legitimate capacity swap, but you shouldn't be accounting for it like this, right? You're booking the 100. You're treating the revenue side of the transaction. We're booking all right now, but then the expense side of the transaction, you're spreading over 25 years, and that was not good accounting.
Lots of ways to take money, right? So Josh and Callie, take a minute and let us know what one or two takeaways might have been from that. We're next going to look at risk factors, and as we look at risk factors, we will, these are risk factors to us in the way we're reporting our financials. And see, these are risk factors to your company. So these are things that our banks will be looking at, flags that might go up. And so for this video clip, when we get to it, Callie will be at center, and Mindy, you and she will collaborate a little bit about kind of what some of your takeaways were. We'll give them a minute to make up an intelligent answer. It's interesting when we see this and we hear names that, if you're old enough, you remember all those names, and you're going, wow, we think of brand names as being somewhat bulletproof and being part of the American dream and part of an honest way of hitting it big. But temptation, regardless of how many decimal points it is, hits all human beings, and companies are sometimes tempted to do things that are just flat out wrong. And that's the world that we live in, but I don't want that to be my money. And I don't want to be part of that, and I want to stay clean for my family, so we don't.
Everybody in the construction business does all those things.
Well, you know what, that's very interesting.
And
Yeah.
not like meaning to do it.
Right.
Not being fraudulent, not
Right.
being.
And small businesses, like I said, are often able to pull it off and not get caught. But they may get caught when somebody tries to buy them out. And so their exit may get screwed up because of practices that were shady, and now they don't believe the rest of the numbers. So it screws up a deal.
I think about just those two videos, and think about the way that UDOT does all their biddings, the state of Utah itself.
I'd like to see that. That if they're doing it, then somebody ought to cry foul. Now, public accounting is slightly different than what public companies are required to do. The rules are slightly different. So the state of Utah has a different set of rules because they're operating to budgets, not to a profit. So they're operating to an allocation. So legislative allocation, that's their number that they have to be accountable for. But that's our money.
Well, I mean, like, the way that they're, the way that the highways and freeways get built is everyone knows.
Well, there's a lot of, every now and then there's companies that go down for it too. You know, that there's some technical rules, like for example, since we're talking about state highways and that kind of thing. If I bid on a job to put in a bunch of exit ramps on I-15 up in Salt Lake, and during the Olympic period, there were companies that did that. Wasatch Contractors was who got the bid for that. They look at equipment required to do that job, and one of the pieces of equipment, they need bulldozers. They need 10 of them, and that's what's required to do that job. Well, technical accounting rules are, if that bulldozer has been bought by state of Utah money, that is our money. And that bulldozer can't be sold. It can't be kept by the contractor. It is a property of the state of Utah. And if they sell that, they're selling public money asset and not giving the money back to the public. And so that's illegal to do. It's done, like you just said, it's done, but every now and then, again, somebody catches them and they go down, and they, because they can't do that. That was just an example. I used bulldozers, but it's any assets have been purchased and used up, financially used up on a government contract. And that's true for federal contracts as well. It's state and federal. It can't be,
You know, I could make a living.
need to hook up with a lawyer is what you need to do.
What do they do with the bulldozer when they don't need it anymore? If they can't ever get rid of it?
If it's financially used up, if they've amortized it to zero, they have to bury it. And
That's the reason why the army goes over to Afghanistan, they don't bring the shit home, they dig up a trench and
they
burn it
do.
all and leave it open.
That's why. And that hurts me because that doesn't seem right either. And there's a guy downstairs in the machining group that owns a mine in California that's deep down, and there's all kinds of equipment down there. It was paid to get the mine out. It was California money. It was paid, and they can't pull it out. It's down there, and the mine's done, and this guy owns it, but it's nothing he can do with it. And it's like, that's wrong, because it's still worth something. I'm an old car guy. You don't crush an old car. It's still it's still got value, right? And so that's not the purpose of our class today, but that is you pointed out truth. Really, that's what does happen. Just don't get tangled up in it ourselves, because if we get tangled up in it, at some point in time we might be the public example to set it. If it's illegal, it's illegal, and the people that do it, I mean, it's illegal to hire unpapered laborers. Do you think there's any of that going on in St. George? Yeah. But it's illegal. So you make a choice ethics-wise whether you do it and hope to get by with it or not. Okay. What'd you come up with, Josh?
Well, a lot of it made sense for the whole part of not doing it, but the one part that didn't make sense into the balance sheet or anything like that is the last one, requesting the cable network kind of thing. If they're exchanging the equal amount, how would that even show up on cash flow?
Because what they did is they capitalized that purchase, and then they amortized the capital expenditure over a period of years, and they took the revenue against it in the first year. So that was false revenue. They didn't have a direct expense against it. The numbers he threw out was $100 million. They capitalized that as a capital asset, which they then depreciate over time. But the revenue associated with that $100 million for the other fake sale, they took $4 million in expenses and $96 million in profit that year, which was a false profit. It's a paper profit only.
Well, I mean, they really wouldn't be or losing anything because it's an equal.
So it was an account, in real life, they didn't gain or lose anything. In paper life, their investors thought they made $96 million in profit that they did not. So that's where the fraud occurs. Is the shareholders were led down a garden path thinking they had profit that they did not actually physically have. And that's the main part of the foul.
And in doing that, would that also change like the stock of the company? Or
They went out of business. Yeah, they were forced out of business for doing that. We can look that up and learn more about that. But that's a valid comment and valid question you have. Callie, do you have anything to add?
Not much. I found it interesting that companies will ship empty boxes to customers so they have the paperwork to show
Yeah.
they shipped.
And so if they act like it's a mistake, then you just correct it out and nobody's the wiser. Even though you did it on purpose, the customer isn't the wiser. Otherwise, that would take collusion, wouldn't it, on the part of the other party? They'd have to be participating in your game and choosing not to blow the whistle if that's what it was. But the consignment part of it is commonly done. When the sales are posted is up to the ethics of the company, but Wilson Electronics here in town, for example, their two biggest customers are Amazon and Best Buy, and they ship a certain amount of product based on anticipated demand to both Amazon and to Best Buy, but that is technically by agreement on consignment. Though Best Buy and Amazon doesn't pay for it until it sells. And so that's an agreement that Wilson Electronics has, is saying, we want you to have the available product, so we will build it. Instead of us putting it into finished goods inventory, we'll put it into Amazon's warehouse. It's our finished goods inventory, but it's at your place. And if and when you sell it, we then will take the revenue at that point. Now, as long as they stay legal on that, it's a perfectly fine thing. They're tying up their cash at Amazon. They're tying up their cash at Best Buy. And grocery stores operate the same way with some of their inventory. They contract for certain amounts of product, and they don't pay for that product until they actually sell it. We kind of saw that Apple was kind of doing the same thing, right, with their laptops. It's like, they're paying for it when they sell it, but they've got it in a warehouse right across the street or wherever, and it's technically not theirs. It's consigned goods, and so that's not a bad business idea. It's bad if they're lying to the shareholders about how it's being recorded. And if I think that the profitability is one way and I realize it's not, as an innocent shareholder, the law is protecting us for that. And so banks are looking for that. They're judging our ethics all the time. All right, one more, and then we'll break and talk about something else. We're going to look at the risk factors, and this one will be Callie and Mindy will assess that.
It's difficult to know when a company's committing accounting fraud or earnings management, but when the following risk factors are present, there's an increased chance that the company's engaging in some kind of financial statement manipulation. For example, when a company is going public, it's putting its financial statements out for investors to see and the general public for the very first time. For example, in the United States, you have to file what's called a Form S-1, and that's going to show the company's financials for the past few years. The company is trying to raise money. That's why they're going public, so they want those financials to look as good as possible. So they might overstate their revenue or make their earnings appear higher than what they actually were. Now, if a company is just shy of hitting an earnings target, and by earnings target, I'm talking about the analysts that follow the company. Let's say that they think that the earnings are going to be $1.37. Okay, the earnings per share is going to be $1.37, and the company believes that it's going to hit $1.36. And they're like, oh, we're just shy. We're just shy of hitting that target that everyone was expecting us to hit. If they come in with this, the $1.36, that's called a miss. It's called an earnings miss, and the stock price might decline because people are like, well, we were expecting $1.37. You didn't hit that. We had this built into our expectations, so the stock price goes down. So the company might engage in some type of financial statement manipulation to go from $1.36 to $1.37 to hit that target because they want to avoid the stock price decline. And maybe it's also possible that the CEO or other executives are on the verge of receiving a bonus. So if they hit certain targets, whether it be hitting the earnings target that's expected by analysts, or maybe some sales target. Whenever there's a bonus on the line, or you're trying to meet certain expectations, there's an increased likelihood that the company might game the system and engage in some kind of accounting manipulation to hit that target. Also, when a company is trying to maintain a streak, so Under Armour had a streak where there was multiple quarters in a row where they had 20% sales growth, and they were trying so hard to keep that streak alive. And basically, one of their major customers, Sports Authority, went bankrupt, and this streak was in jeopardy. So Under Armour engaged in some channel stuffing and basically trying to move sales for the future pull them into the current quarter to continue that streak and keep it alive. So whenever there's a streak that's going, and the company doesn't want to end the streak because then people might dump the stock. So if they're maintaining a streak, they're trying to hit an earnings target, there's some kind of pressure involved, they're trying to get a bonus, they're more likely to engage in some kind of financial statement manipulation. Also, when the CFO, let's say you have a company that has 3 CFOs in 3 years, that's high turnover, right? You got a new CFO every year. How committed is this company to releasing quality accounting information and quality disclosures when every year we've got a new CFO? And anytime, just in general, when the CFO or the CEO of the company just abruptly resigns, they'll always say, they're resigning for family reasons. They want to spend more time with their family. Everybody wants it. That's great that they want to spend more time with their family. But they might have committed accounting fraud too, and that might be contributing to that. So anytime there's some kind of abrupt resignation, particularly the C-suite with the CEO, CFO, you just want to be wary. None of these things are guaranteeing that there's an accounting fraud or earnings management going on. You just want to be cautious. Now, if the company's close to violating a debt covenant, so that is a situation. So a debt covenant is it's an agreement with a lender, for example, that the debt to equity ratio can't exceed this certain amount. It can't exceed 5 or something like that. So there's some threshold, and if they exceed that, the lender could technically call the loan due or impose some kind of a penalty. So there's research that shows that companies will engage in earnings management, try and manipulate their profitability to be a little higher, or if we're talking about hitting a ratio like the debt to equity ratio, try and engage in some kind of behavior that would make the ratio so that it does not violate the covenant, so the company doesn't have to incur any kind of penalty or potentially have their loan called in. Now, when there's intense political scrutiny of a company, like for example, they're being called a monopoly or something in the press, and maybe in the US, if we're thinking about like Congress getting involved and talking about regulating the company actually have an incentive to manage their earnings downward and maybe make it look less profitable than what the company is. Because if you're being accused of being a monopoly, and legislators are talking about passing laws to regulate you, do you want to be like, oh, look at how profitable we are, look at how much money we're making, we can't believe it, we're just dominating the market, it's like we have no competition. Now, if the company is taking restructuring charges, like it seems like every year there's a restructuring charges it's a question like, well, what's in those restructuring charges? And sometimes, like for example, the company Sunbeam. So Sunbeam was putting things in restructuring charges, like they write down the inventory more than what needed to be written down, and they take other expenses that they would then reverse. You take what's called a big bath. Okay, so you have like a CEO who takes over the company, and their job is to turn it around, and so they take more expenses and take a bigger loss when they first take over the company. Like this guy named Chainsaw Al, he was the one who took over Sunbeam. They took more expenses than what they needed to, and then you reverse some of those expenses the next period, and you basically say, like, look, I just took over the company. People expect the company to have a bad quarter or a bad year, so I'm going to take more expenses than necessary so I can back some of them out the next year, and then next year will actually look more. So this year looks worse than what it was supposed to, but the next year looks better than what it otherwise would have looked at. And now, I want to get into some characteristics of companies specifically. So like what type of company in terms of the size of the company, large companies, medium. And it turns out that smaller companies are more likely to be engaged in some kind of financial statement manipulation. Okay? Smaller companies, now why? Well, smaller companies sometimes have weaker internal controls than some really large company. Okay? So if the company, internal controls, remember those are things that are put in place to prevent some kind of financial statement manipulation, whether it be purpose, financial statement that was like literal manipulation, or by accident, from any kind of manipulation taking place of the financial statements. So these controls are there to prevent issues from coming to the financial statements to begin with. But if the company has very weak or non-existent controls, then that's going to be an issue. You're more likely to have some kind of fraud. Now, if you have for example, in the United States, if you have a large publicly traded company, they're going to have an audit committee. But if you have a smaller company and they don't have any kind of audit committee, or the audit committee doesn't meet very often or doesn't take their job seriously, then that is going to be an issue. Because remember, the auditing committee, their job is to hire the company's external auditor. And then if the external auditor finds any kind of issues, they go to the audit committee. They don't go to the CEO. They go to the audit committee and report whatever the problems are, and the audit committee is supposed to deal with that. But if there is no audit committee, or they don't meet very often, then obviously that isn't there to be able to check against management in terms of dishonest financial reporting. Now, if you have a board of directors that basically has no control over the CEO, which in theory, the board of directors, remember, they can fire the CEO. That's one of their jobs, is to hire and fire the CEO. But sometimes you'll have a CEO that just has a lot of power, and the board isn't putting them in check or doing anything like that, and the CEO just has complete reign over running this company. Then that could lead to issues because there's no oversight here. Okay, there's no oversight it's like having basically letting a small child run the company and giving no oversight to that child, or just letting a small child be in an amusement park for the day with no security, no parents, anything like that. What are they going to do? Well, all hell is probably going to break loose. Now, when we have a company that has a lot of insiders and family members, so I'll give you an example. Adelphia. So Adelphia had, I don't remember how many it was, people on the board. I think it might have been the majority of the board of directors was somehow a family member of the founders and executives who were running the company. They are less likely to question the company and management in terms of the quality of financial reporting, right? Because they're related. So they might be in on whatever's going on, or they don't want to come in. What you really want, ideally, is an outsider, somebody who doesn't have any kind of relation to the CEO or whatever. They just come in and they say, look, I just want to make sure that there's honest financial reporting going on here. Now, related party transactions can also be a significant issue, and Adelphia also had issues with that. So related party transaction is like, the CEO, they own this other company. They own some other company. So they own company C over here. They own company C, and company C is engaging in transactions with Adelphia or whatever. So we've got, or maybe they own a couple different companies. They own company D, company C, and these companies all have transactions with one another. And the commonality here is the CEO is in charge of all of them. So the CEO might be able to structure some transactions where maybe they'd have a sale, or make it look like Adelphia made a sale to company C or company D, but in fact it's not really a sale. It's just something done to make Adelphia's financials look better. So anytime that you have related party transactions, and this is a red flag just in general. When you have related, particularly when the company is not disclosing them. The company is supposed to be disclosing related party transactions, and if they're hiding them, then that's even worse. Okay? Now, and finally, I'll just say, when there's a huge amount of pressure for the company's executives to meet the targets. Remember I talked about when I said that there was earnings are expected to be $1.37 per share. So all companies obviously want to meet their targets, but some companies will have really just inordinate pressure being placed on management that your job is to hit these targets by whatever means necessary. And I'll just give an example of an advertising company. It's called Interpublic. And Interpublic years ago was involved in accounting fraud. And I read the SEC complaint, and it talked in detail about how executives at Interpublic constantly face pressure. It is your job to make these targets. If upper management gives you a target and says this is the sales target you're supposed to hit, or this is a profitability target, you are to hit that target by any means necessary, whatever you got to do. Now, what does that do? That gives the lower level managers and so an incentive to engage in dishonest behavior for example, recording fake sales and things like that, and that gets in the financial statements, and then you can't trust the company's sales revenue, its profits, and so forth. So we're going to talk more in the videos to come about how you would go about detecting financial statement fraud. How would a company overstate its revenue? So hang tight. We will dig into this fraud in all its glorious detail.
Okay, so take a minute, Mindy, and converse about a walk away or two from that. Let's see if I can do that. Yeah, I can. The way this works, I'll start an explanation after we hear a couple of things from them. In a real world, when an incentive is there to change the value of the company, we would see that in the notes. We would see that in your Investopedia, in the game that we're playing. You will see the volume, data about the volume, and that volume means how many shares sold today of IBM. That's a trading volume, and so if we see the trading volume being like this, it's going along, and all of a sudden on one day the volume shoots way up. That's a heads up for us to go, what happened there? Is that good or is it bad? And so we want to go and try to figure out what happened. And sometimes we can't find out in real time what happened. There will be speculation. Wall Street will ask questions. Eventually that'll get reported on the annual report that, maybe what happened was a bunch of officers of the company exercised options to buy stock. And so those were people in the company actually buying in. A bunch of them bought in on the same day. They exercised options because they had a lot of them. And so that's a good sign. That tells me the people that are working there, a lot of them bought in. But what if it's the other way around? What if we find out the CEO is selling his stock? Or her stock, depending on which way it is. And that volume represented people bailing out, rats jumping off the ship. The investors need to know about that, right? So as we watch volume of transactions going, that can be a signal to us that there's something going on in the company. It could be positive, it could be negative. So we need to not react to it, we need to find out data, facts. What did you guys think about that?
So I found it kind of interesting that some companies, like when they're taking restructuring charges, they'll take more than they need to on clients to next year to make it look like they could more and do better than they actually did.
Yeah, we call that sandbagging. A lot of times you're laying in, to make, you've already wrote this year off or whatever, and or you've made the numbers. No reason to go over, save a little for next so that you get a tailwind going into the period, into the quarter of the year. It's an interesting thing.
Yeah, I basically didn't understand anything that you were saying. I'm not gonna lie, my eyes were really glazing over a little bit. But I thought that it was interesting, like we've dealt with Sunrock and Interstate and those companies, and it seems like their board of directors is all family members and their CEOs, and I mean,
they wouldn't make it as a public company with that. The Securities and Exchange Commission would require some arm's length personnel involved in that. It's fine for family business. I want my company to be made up of just our people, whoever my family is that I want. And so just that alone doesn't mean that it's a badly run company, but that alone can mean watch, because there's a temptation there. And the patriarch of the family has the ability to force things, and you got to go along or else you're going to get thrown off the train. And so that can cause, and that's what we're looking for, is things that would be just red flags for us. And that's all he's saying there. It's a risk factor. He's not saying it's illegal. For a public company, it probably is. There has to be some other people involved to represent the small shareholders. The widows and children is what they call it in court, that have inherited pieces of stock. They need protected. And so you don't want one family railroading it down. Sometimes it does happen that a family buys back a company and it delists from being a public company. So it's no longer, if you are still an investor in that company, you can't buy more, but it's there. You no longer have the SEC protections. You have law protections for lying, for fraud, but it's not quite the same. There's nobody watching your back on their board of directors. So if they put a board together that's solely for themselves, then you're at their mercy of that. One of the risk factors that you saw was if a son or a child CEO. You and I talked about a company where exactly that happened. Someone that was not of legal age, really, even was the CEO of the company, and he did his best, but he was in a situation that he couldn't win, and he had fun at the same time too. And so that was maybe a little bit, you just didn't have the maturity of leadership and direction, and he was kind of put in a spot where. Very hard to win, and it's easy for us to call it from the outside position. But the factors that they're talking about, let me give you an example of why I blackened the screen. We saw the Super Bowl over the weekend. We certainly can go on break. I'll tell the story when we get back from break, and we'll start something else. It is 7 o'clock after all. Sorry about that.
Don't be sorry. Yeah, I knew all you guys had to go to the bathroom. You're welcome.
We'll start back. I think that, Mindy, your comments are appropriate. Enough terms in our brain starts to go cross-eyed. So maybe enough video. We'll do some other, talk about some other things. We'll watch one more video. It's a 4-minute one, so not very long. And at the moment, in Brock's momentary absence, Andrew and Mindy will look at this and report on it. Going to look at Under Armour. He brought up Under Armour, what happened in Under Armour. So let's take a closer look at, did Under Armour commit accounting fraud, is the name of the question.
To challenge industry giants like Nike and Adidas. But recently the company's been accused of accounting fraud. So I'm going to dig into the details here today. Under Armour was founded by Kevin Plank, a football player at the University of Maryland. After starting the company in his grandmother's basement, Plank led Under Armour to rapid growth. By the time it went public in 2005, Under Armour was profitable with $281 million in sales and positive cash flow. Under Armour's sales continued to grow after the IPO, and the future for the company looked bright. But in 2016, Under Armour got some bad news. One of its largest customers, Sports Authority, was going bankrupt. Under Armour had achieved 26 consecutive quarters of 20% sales growth, and it looked like the streak could be over. And this is where things get sketchy. Under Armour allegedly started pressuring its customers to take more product than they actually needed. Customers went along with this as they were given discounts and told they could return extra product the next quarter. And that they did. According to the Wall Street Journal, truckloads of unopened boxes would come back. After reading this, I dug into Under Armour's financials to see if this actually happened. I pulled Under Armour's 10K for each of the past 8 years, and I focused on an account called Reserves for Returns, Allowances, Markdowns, and Discounts. This is a contra revenue account that Under Armour records whenever it makes a sale. In its 10K, Under Armour says, quote, "We record reductions to revenue at the time of the transaction for estimated customer returns, allowances, markdowns, and discounts. We base these estimates on historical rates of customer returns and allowances." So if Under Armour really did start pressuring customers to take early delivery of product around 2016, we should see the reserve account increase at a faster rate than sales did during that same time period. And this is exactly what I found. In 2016, Under Armour's gross sales, which were sales before subtracting the reserve account, increased by 22%, while the reserve account increased by 54%. The next year, in 2017, gross sales increased by just 5%, while the reserve account increased by 68%. The reserve account was increasing a lot faster than sales. But that's just one way to look at this. We can also calculate the percentage of sales that Under Armour estimates will be returned. This figure was consistently around 2% between 2012 and 2015. Then in 2016, it increased to nearly 3% before jumping to nearly 5% in 2017 and 5.5% in 2018. It decreased in 2019, around the time the SEC began investigating Under Armour. These spikes in Under Armour's reserve account around 2016 are consistent with the story that Under Armour had been stealing sales from future quarters by pressuring customers to accept more product than they actually needed. Now, there's nothing wrong with applying a little pressure to make a sale, but if you know the customer doesn't want the product and they're going to return it anyways, then it's not really a sale. At best, it's a sale for a future quarter that you're trying to record in the present quarter, and that is a violation of GAAP. Under Armour CFO stepped down after the company's 20% sales growth streak came to an end, and the company went through 3 CFOs in just 2 years, which is another red flag. Now, Under Armour has been struggling, so it wouldn't be that surprising if it was aggressively pushing its products. Under Armour apparel doesn't seem to be as popular as it once was. The company had to write off $5 million of inventory in 2017 and another $20 million of inventory in 2018. Now, none of this guarantees that Under Armour committed accounting fraud, but the financials paint a picture of a company that was increasingly having trouble selling its inventory and thus might have started aggressively pushing that inventory on retailers, which was suggested by the increased rate of returns. We'll have to find out when the SEC releases the results of its investigation whether Under Armour actually committed accounting fraud.
We don't think of companies like Under Armour as being even just possible, right? That just doesn't seem to be something that we would expect. And I'm not saying, and he's not saying that they did. As a matter of fact, they survived the SEC investigation, which they did that in part by having CEOs step down and replacing them, saying, we're trying to get our ship in order. We're trying to properly report. The fact they had reserve accounts is a good thing. But from our perspective, we are, in this class, simply looking at why we need to understand how to read financial statements. And there was a clue, there was an example there that we could have seen that there's something going on. We don't know all the answers, but part of it was alluded to in the write-up to their notes that he quoted there in their annual report and in their 10K filing with the SEC. So if we choose not to read that stuff in a company that we're investing in, that's on us. If we don't understand it, that's also on us. We need to reach out to people that do, and I think that there are people that breathe accounting far more than I do, but I know enough to know when I need to ask for professional help on something, to take a closer look at something, especially if we're parking our company's money in investment so that we don't just get the 2% the bank gives us, right? So that we are getting a better return because maybe we're banking for growth in 5 years or something else and we're accumulating cash and want to do that. So the story I was going to tell about financial risk, that financials are being manipulated or misstated. I'm just going to give you a real example from my life experience, and some of you know this already. So it is what it is, and it's part of the history of a company. I was working for a company. We made diagnostic ultrasound equipment and cancer treatment equipment, and we had plants around the world. And a small company on the grand scale of things, but we were the largest in our market segment. And that company was public. We were traded at the time on the American Stock Exchange. The company had a sizable investment. What I started to say was, at Super Bowl Sunday, we saw the trophy, the Lombardi Trophy, given to the Kansas City Chiefs, and Clark Hunt was the recipient of that trophy. You saw him if you watched after the game. He was holding the trophy up, and his wife's behind him. Clark's uncle was the chairman of the board of the company that I worked for. Bunker Hunt was his name. Clark's father was Lamar Hunt, and Bunker and Lamar owned the Kansas City Chiefs. Lamar passed away, and Bunker had a sizable holding in our company. Now, Bunker's grandfather was Texas Oil. They were part of the strikes in around Midland, Texas. Lots and lots of oil fields there, and they made grundles of money. And so the kids didn't know how to spend it, and some of them spent it well, and some of it spent it poorly. They bought all kinds of things. Bunker Hunt bought 33,000 thoroughbred racehorses, for example. He owned like 9 out of 10 racehorses in the world. So if you saw the Kentucky Derby, he was money behind a few of those horses every year. And he had stables in Dubai and the United and Saudi Arabia and all kinds of holdings in that. But the story is that the company that I worked for, which the stock letters for it at the time was BSDM, and it has when we look at cap rate of a company, what is the valuation of a company on the market, we look at all the stock the company has, and we look at that in a pie chart, and maybe the company has retained some percentage of ownership that the company owns, and then we have investors that own all the rest of the pieces of the pie. And when it comes to Tesla, there are millions of investors that have a small piece of that pie, so it's sliced up really, really small. Warren Buffett, when Berkshire Hathaway buys into a company, they often own up to half or sometimes even more of the company. They own a large slice of the pie. Well, this company had about 9% of the company was owned by Bunker. And for a public company, that was a fairly good size percentage. The CEO of the company was a guy who had been instrumental in developing it to its public stage, owned 41% of the company, so he had like this much. And his name was Allen. He was the CEO. Bunker was one of the significant investors. Now, there's an interesting thing there. 41% and 9% equals half the company. They actually own 41 point something and 9 point something. So those two people alone had controlling interest in the company. They owned over 50% of the corporation, and therefore they could get together and go to the board of directors and get their way if they wanted to do that. Bunker got caught selling silver on the U.S. silver market, and they were trying to Bunker and his brother, they were trying to control the price of silver by buying and selling more volume of it than anybody else to kind of artificially drive up the price of silver. If you want to read about that, that's written heavily about on the internet. You can find lots and lots of things about that story. The U.S. has put safeties in place now to try to prevent heavy metals from being manipulated by private investors. I guess it's been successful up to this point, but Bunker was forced into bankruptcy. And when he went bankrupt, this was the largest bankruptcy in the United States. $2.2 billion were his assets at the time that he was forced into bankruptcy. He was forced into bankruptcy by the IRS. So the IRS looked at Bunker's manipulation of the silver market and said that he owed money on many transactions that his accountants say he didn't owe tax on. So that was the way that they were going to shut the Hunt brothers down from manipulating the world price on silver, was by pushing him into bankruptcy. Well, it turns out that part of this bankruptcy, a very, very small part of the bankruptcy, was the company I worked for. 9% of that company was at stake. This guy, Allen, looks at that and says, Bunker's in bankruptcy. If I could drive the price of the stock of the company down without killing the company, I could buy this 9% from the bankruptcy court, which was the 5th District Court in Dallas, Texas. I could buy this from the liquidating trust that's set up. So all of Bunker's assets were seized and put into liquidating trust. We saw that happen here locally when all of Jeremy Johnson's assets were seized and then were sold off. Some of you went to the auctions of some of the toys that the liquidating trust had from the FCC, it was in his case. Here it was IRS was driving this liquidating trust, and a judge had to sign off on everything that was being sold. So Allen could go to that liquidating trust and buy this 9% if he had the money. Well, the easiest way to have the money is for the stock to be not worth hardly anything, right? So that 9% would be based on the cap rate. The cap rate of a company is the number of shares outstanding divided by some other stuff, and you get a number based on return. And so the number of shares outstanding would determine how much this 9% was actually worth based on the stock price at the time. At the time that bankruptcy was filing, the stock was worth $17.50 per share. If you had 1 million shares, you'd need 17.5 million to buy 9% of the company based on the company's valuation at the time. Allen didn't have that. So he started a process of making mistakes in the company that I worked for to drive mistakes that Wall Street reacted badly to. We're going to have this amount of profit, here's a 10Q, we don't. And so the price of the stock started spiraling down to, at some point, it reached 50 cents. All right, now it's affordable to Allen. But while this decline is happening, while this spin down is happening, the IRS is looking at that list of what are the red flags for fraud in a company. And the red flag here was that Allen, if he could make the price low enough, he could afford to buy control of the corporation. That was damaging the value of the portfolio that the liquidating trust was trying to sell, if that makes sense. And so they cried foul. By they, the people overlooking that trust that had the most interest was the IRS, because they were who the money was owed to. So the IRS did not want to see the value of our company to go down. The IRS actually, when that bankruptcy occurred, the IRS had a seat on my board. We owed the IRS a lot of money, and the IRS is on my board, which was a very interesting scenario. I'd never dealt with that before. But the IRS is who cried foul to this. And they fired Alan in one day, and that's when they called me and asked me if I'd be CEO of the company to try to put the pieces back together, which I did and we did. But this is the driving point that just was off of a red flag. So you can kind of see how it works. They saw opportunity. Nothing had been done wrong there. Later, he took all the cash out of the company the day that they fired him. The morning of that day, he took $2 million in cash out of Zion Bank in Salt Lake City. And did that at every branch he could go to, took all the money they had. He took cash money. And usually banks don't have that much cash. So he had to go to branch to branch to branch to find how much money was in their vault, because he had the rights to do it. He was a signatory on the account. And by the time the flags hit IRS, it was late in the day, and that was when they fired him. So he no longer had authority at Zion's Bank, but it was too late. He'd taken all the cash out of the company. So I received a nice little job of putting a company back together that had no money. And it was December 17th was the day. I will never forget that day. It was a long time ago in my life now, but it was December 17th, and we had just passed out the Christmas checks for all employees. And the U.S. didn't like that, but the Chinese government, when you bounce a payroll check in China, they go ape. They got guys with guns, and they don't like that at all. As you know, none of us like it, but in China it's a little bit different set of feudal rules and modern rules. But anyway, that didn't happen. This is from a red flag, though, that you see who could profit from a decline in stock. Now, the risk you take in doing that is you could completely bankrupt this company, right? You could overplay it and get it down to the point where the company really truly was worth nothing and would have to collapse. He was carefully driving it so that didn't happen. But he was announcing things that were less consequential that drove the price of the stock down. And so the investment community didn't see the reality of what was happening. The IRS did see the reality of what was happening. His last name was Himber. If you know where he is, he's not been seen since. He literally, we think, left the country. It was a scenario. There's probably something somewhere somebody knows who he was. But that is an example of red flags and how they could preserve a company. The company later, I relisted it on, I closed it out. I took the company private. I then took the company public on NASDAQ. So it was a bunch of manipulations that were done. And we'll later talk about IPOs when it's appropriate to do that. Right now, I want us to talk about a couple of other things. We'll be done with movies for the day. And I think that there's some things we can learn from some others, but I don't want us to, we got no popcorn. So it's not fair to watch movies without popcorn. Let me get that turned back on, and I'll erase what's appropriate to erase here.
If Alan would have bought the company at a low price.
What would have happened?
Yeah, I mean,
I don't know. That's up to speculation. He wasn't, in my estimation, I spent a lot of hours with him. I reported directly to him. He wasn't really what I would have called a bad guy. He was a weird guy. And he wanted to mirror, he worshipped Howard Hughes. And he viewed himself as a Howard Hughes. He was trained in law. He was a Jewish lawyer from Manhattan. He grew up in Manhattan, and he had watched Howard Hughes's career, and he tried to mirror the things Howard Hughes did. Howard Hughes hired a lot of Mormon people, so he established a company in Mormon territory to do that because he thought that there was corporate advantage from doing that, the ethics and the things we know about that do make sense, and Howard Hughes did that. I think he ultimately would have leveraged just out of the healthcare industry into the aerospace industry, like Howard Hughes did, and so I don't I don't know if he'd have been successful what he'd really done. He was a weird guy. He lived in a hotel, never was married, never had a house. He put $19 million into this company when he started it. So, he had cash and at one point, and didn't have a driver's license, so I picked him up at his hotel and drove him around. I mean, just like Howard Hughes. You know, he had put gloves on his hand he only drank Avian water. That was it. And, you know, he had to go back into the kitchen in a restaurant and see how the food was prepared before he'd eat it, because he was deathly afraid of AIDS and other disease. Just a weird duck. Wouldn't let housekeeping clean his hotel room. I mean, just a lot of things that were, it was a life experience. It was,
Trying to like mirror Howard Hughes.
he was.
Almost.
He even ate the same flavor of ice cream that Baskin Robbins made specifically for Howard Hughes. I don't remember what it was, but he had it. He had Baskin Robbins make that flavor, so it had it delivered to the hotels that he'd stay at. I mean, it was a talk about red flags, huh? But I made good money there, and so sold my soul to the devil. No, I don't think so. That stuff. The only illegal part about was allowing. I mean, I don't know. Say it's illegal. Bad judgment part is making poor decisions that are going to drive the stock down. And if you could show that you did that on purpose, I suppose you could be criminally charged for that. But he didn't stand trial because I couldn't find him.
Is it wrong to drag the company down to get it to more affordable, or is it the part that's questionable is that he was trying to drive it down for his own?
That's what the IRS convinced the judge of, that he was doing it for personal gain. And one of the things we haven't talked about in this class, if you're an officer of a company, your fiduciary duty is to the company before to yourself. And that means you have to watch out for the gain of the company, even at your own loss, technically. Now, you try never to do that. You try to keep it at a win-win. But technically, when you are on the board of directors or you an officer of the company, your allegiance is to that company. And it has to be by law. And if you're found to have breached your fiduciary duty, you're not allowed to be an officer of a public company again in your life. You know, it's a indictment against you for doing the wrong thing and making the wrong decisions. And maybe I think it should be that way. That's not a bad thing. All right, enough of that story, I think, and I promise no more videos. So last class, we were looking at the DuPont analysis of these companies, and we found out, we were doing a 5-point analysis. This is the data from the 3-point analysis that we calculated in class. Now, we looked up all of the numbers and the financial statements together in class, and we got to the end of class, last class, where some of us the math didn't match between the 5 and the 3, and I said I would double check all of that. I committed to do that. That was Tuesday, day before yesterday. I went out of town last night, got caught in snow. So I didn't get it done, but I will get it done this weekend. I got it started, and what I got started was this much. We knew what we found out from Wilding what their net margin was, what their total asset turnover was, and what the financial leverage was. And it was interesting. It was a value, but we didn't know what a comparison company was. And so at the end of class, you guys gave us the name of 2 companies that are comparison companies. Better Bed was the larger of the 2, and
It's not Better Bed, it's Breda.
Breda Bed.
Breda Bed.
Well, there's both. Hold on just a second. Hold on.
I was looking this up earlier today.
That's not what I want. This is...
You guys need to get a life.
Hang on just a second. I've got their annual report, so I'm going to go to their annual report. Better Bed.
No.
This is the company that I looked at. Now you have
I
a...
don't think that these guys are our direct competitor, right? They don't do wall beds.
They do.
Oh, they do?
Yeah, they do.
Okay.
They do other beds, but they do wall beds, and they have words for them here. This is a 149-page annual report, only which I've read the financial stuff, but I haven't read all of the drop-down stuff. But they do wall beds,
So by having, this is
but they also do
coincident, though.
they do other stuff as well.
Yeah.
And
So,
Breda is
Beds
in Idaho.
in Idaho.
Yeah, and I don't have financial data for them yet. but
Right.
I have financial
They're-
data from
they're a
this.
private company, Breda Beds.
Okay,
And then, Better Way,
okay,
which would be BEDDER.
okay,
Yeah, they're a private company too.
okay. I have that written down as well. So I looked at this company, Better Bed, and by the way, this company is in Europe, and so their financial statements, which we have, their financial statements are in euros
Gotcha.
as opposed to dollars, and right now the euro is $1.07. So the euro and the dollar are close enough to consider them about the same from our perspective. Hang on just a second, the financial statement from them. Here's their consolidated financial statement, their balance sheet, their cash statement of cash flows, and just taking from these numbers, and I'm not done with my homework one. Yes, I will do it over the weekend, and we'll report to you a little bit more tomorrow, Tuesday. But what is of interest to me on that is that we were concerned about, excuse me, Wilding's net profit margin of 6.49%. And it was interesting that on a much larger company, Better Bed, their profit margin is exactly the same, which that it's not exactly potatoes to potatoes comparison. They're in a different market. They ship to the U.S., but they have other products as well, like he's pointed out. It's a holding parent company, and that's part of what I need to do from a homework perspective is go back to look. But what we're seeing is that from this data and this data, we're seeing that Wilding has focused heavily on flipping their assets faster. In other words, the throughput in the plant has been focused on heavily, and it shows. Throughput at Wilding is twice what the asset return is at Better Bet. Now that looks like good news at the front. The other interesting piece is that Better Bed is leveraged out twice as far. That's a two-edged sword, right? It's leveraged out twice as far, meaning they owe more money, but it also means they're using more capital to, their turns aren't bad. Their turns of 150 are good turns, so the more money they borrow, the faster it grows. That's what it is saying there. And in the case of Wilding, they could borrow money and it would grow even faster proportionally. So if Wilding was looking at just a head-to-head race with this one company, that would be the strategy to win that race, is because if you can sustain that asset turnover, then if you were to borrow some more capital to go in, it would be affordable for you to do because you've got a decent margin and you've got a huge velocity. And so that would be that's the kind of thing that the officers of a company should be talking about at an annual strategic planning retreat, saying, how do we want to stage our growth? And in this case, there's evidence that says that we could benefit from doing that. But the caveats are, you'd have to hold both of these in order for that strategy to work. If you didn't hold them,
Our turnover is actually going to go up.
I like it.
Yeah, we're redeveloping one of our major products to align to the shipping restrictions that we have, right? And it's going to reduce the cost of manufacturing. We're going to be able to remove portions of the bed that are no longer needed, which will increase the time it takes to get out the door. Right now, we're 2 days from cut to ship, right? Before we were 4 days. And changing the way that we build the product is going to probably take it to a day and a half.
Awesome. So that will be in your benefit completely. And actually, this shipping thing turns out to be a disruptive force in the business,
Yeah.
in the business sector, not just yours, but in the business sector.
It's life-threatening.
If you don't manage it, or if you put your head in the sand,
Yeah.
it could be the death of the company. In time, depending on how you play it, the market will accept it because the playing field is level. But it'll take us a minute because it's going to be a higher cost or more work. If you're going to require the IKEA approach a little bit more, then that'll hold your shipping costs down, but it shifts where the labor is done, and whether it's your labor or the customer's labor is in fluid right now. It's something that will pan out. The good news is your competitors are in the same fix, and so if you come up with a solution better than they do, you could take this back to the early days of diesel fuel surcharges in the transportation business. We saw contracts, we saw trucking companies go broke because they didn't know how to manage it, and we saw shippers lose customers because they didn't know how to manage it. By now, we all know diesel's not $2 a gallon, and so it's $10 a gallon in some markets, and we've figured that out as a supplier, as a transporter, and as a customer. We figured that out, and so contracts are written differently than they were ever written before to allow for a fluctuating price of diesel, and protecting the people that have to pay for it to some degree, and in some cases trying to index that to a crude oil. Texas, West Texas crude is one standard index.
I'll tell you right now that the fuel surcharge on freight, I just got a bid from probably one of the largest aggregate haulers in the area. It's 28% of the rate is the fuel surcharge. So if the rate's $10, you're paying $2.80 more per ton to get your freight shipped in an aggregate source.
And that was unthinkable some time ago. I mean, that was an unthinkable amount of money, and a way nobody had figured out how to pass that on. And so we didn't know well, and now we've got enough experience with the fluctuation, goes up and down, and none of us as a customer want the shipper to get rich on times when fuel's cheap. We also don't want to get bankrupt when the fuel is high. We want it to stay a level playing field, and so that's been disruptive. And we're a little bit further along on that than you are on weight per cube, and that's kind of the index that we're looking at now. Now, international shipping has been on that basis for a long time in containers, and so now that's coming to domestic transportation, and it's game changing. And so how you navigate that, it will be critical for the company, and it sounds like you've got some good ideas that you're starting to try to float around, and it may result in some extra blessings, like you just said. You're finding some wasted components, some things that you're doing unnecessarily producing, and so to get the weight down by accident, we are becoming more efficient as well. Yeah. And so that's awesome. We'll take that little break if we can. All right. So the one of the things I discovered from their financials, and I've made notes on it. That says I've got to read the 149 pages, because some of the things that are offsetting and making their earnings look a little bit different are they've acquired a company and they have almost $2 million of a tax loss carry forward. So they're taking some credit for taxes that were paid by another company in another year and a previous year. And I don't know quite how to factor through that until I read their notes that says how they did it, so I can get the right number for the company today. And so I'll do that over the weekend, and then we'll talk a little bit about what it was that we found. Hopefully I'll successfully figure it out and pass it on to you guys so that you can kind of see how we're reading a financial statement. And I noticed that there's a few notes as I scanned Home Depot and both Home Depot and Lowe's that says I got to read all those too, because there's some explanation in the notes that give us more insight into the number that they post in their financials. Now, we knew that was a probable factor. We just didn't take the time in this class to dive there, and I think we will. So we talked a little bit about what happened to the market today as well. And I don't know what happened to.
Tesla finally went down for the first time in a month.
Yeah, it did today, but we have Brandon in the class. It's 26% up from where he was as he bought in. Now think about that. If that was real money in our real life, that's a pretty short time to get that kind of return. Now, it's not a guaranteed return. You could lose it all tomorrow. That's the problem with the market, isn't it? If we knew, we could hedge, and part of that was on the back of Tesla, that your gains were there. Some of the rest of you are invested the same way, and if we all invest in the same package, we'll never pass Brandon. So I suggest you to not just mirror his stock, do the research yourself a little bit. But all in all, we've got almost everybody. We have one person in the class and that is down over the original $100,000 that we put in. We have two that are still at 100 because they haven't moved. But Dylan is down 0.07%. That's not a beating. You know, he's still got his 100,000 almost, $99,930. That's not bad management there. All the rest of us in the class are in the green in the far right-hand column. What that says is that we've all done better than putting the money in a mason jar in our backyard. So, you know, that's part of the lesson in talking with, looking at Investopedia. All right, so the last thing I want to talk about, and we're going to go through this together a little bit, is the Parade of Homes that opens tomorrow. And I want you to kind of run a tally sheet. I think there's 31 or 32 houses, and we're going to go through them real quick because this is real. Some of you will actually go visit some of these houses if you want to play over the weekend. It's a,
I look forward to it every year.
Okay, all right. So it starts tomorrow at 10. The VIP was today for the contractors and so forth. So it's officially kind of underway. So I want you to write the number of the house down. I want you to write down the price that they're asking. And the only other piece of information that I want us to track is the house sold or is it a spec house? A spec house is a term for a house that a builder builds that nobody has agreed to buy. In other words, you will finish the house, then you will entertain offers on the house, and hopefully you can sell it. That's called a spec house. And it's the spec stands for speculation. You're building the house on speculation that you can sell it. Now don't forget, all of the houses that are finished today, they had to be actually inspected by the Home Builders Association, and they had to be completely finished by midnight last night, or there's a penalty. And they really have to be, you know, the trees have to be planted, the grass has to be in, the doorknobs have to all be on. There can't be stuff, because when they open, they're supposed to be done. Now, they get fined if they're not. And then those points go against them about whether they get a house next year, if they get allowed to build a house. So we're going to just
start those. The other thing is that I was a member of the Home Builders Association.
Yep.
They have to start those homes in an ungodly short amount of time.
And bring them in.
They can't be building a spec home for 3 years down the road.
Right.
They have maybe 4 months to
Right. That's right.
start
Yep.
to finish.
Yeah.
It's not like they've been working on it since last year's parade.
No, but they have been planning, and so they've done drawings. They've looked for customers. I don't know if the lot can be developed or not. I don't remember. You would know.
Yeah,
but
the lot they can buy the lot if it's finished.
okay. Yeah.
But I don't know the exact timeline, but they don't have.
Yeah, it's a short window.
365 days.
I agree with that. Yeah, it's a short window that they have to go. So we're going to go through these fairly quickly, and you know, as quick as we can go. This is the order that they have. I was a little bit upset. These first three, they route them right past my front door, so I'm going to be not able to back out of my driveway for a while. But so we're looking at the first house. I'm not looking at who the builder is. This is the first house. It is 2.995, 2,995,000. If you want other data, it is 4,000 square feet, but that you can assess that on your own. The question is it for sale? The answer is yes. So it's not. That is a spec house. The answer to number one is yes. Number two is nearby. And number two is also $2.9 million. It's $95,000 cheaper. It is a little bit bigger. It is also for sale. It is a spec house. Number 3 is down the street just a little bit, the same neighborhood in Stone Cliff. It is $6,125,000. Should be bigger. It's 7,000 square feet, and it is a spec house. It is not sold. Number 4 is a split rock house for $5,300,000.
I mean, who's really buying these houses anyway?
Well, we'll
$6 million.
talk about that. Some of them have basketball courts in front of them. It's like they got kids. What's going on there? This house is not for sale. So this house has been sold by someone. They can't have lived in it. It's new as of the home. Is that correct still?
So they can't live in it, but they might have built this house for a customer
They did.
of theirs and then put it in.
And the
or
customer agreed
sold it
to,
during-
or they could have sold it. Yeah, but you're right. So this is not a spec house though. That is number 4. Number 5 is $5 million. It is not for sale. 11,000 square feet. It's a big house, but it's $5 million. Not in a gated community. Number 6 is $1,635,000. It's a Bangerter home. It is for sale. It is a spec house. Number 7 is $5,499,000. It is not for sale. It's 12,000 square feet. Somebody has committed to that house in Oak Hollow in Washington. Number 8 is an S&S Homes house, $1,699,000. 6,000 square feet. It is for sale. It's a spec house by S&S, one of our builders. Number 9 is Sullivan Homes. It's at $1.2 million. It's for sale. 3,300 square feet. Number 10, $1.7 million. It is for sale. 3,900 square feet. Number 11, under $1 million, $729,900 by Ivory Homes. It is for sale, 2,000 square feet. Our first house.
It's amazing that seems affordable to people.
It's,
Like a starter home.
they didn't start buying houses when I did. I bought houses for a lot less than that. Number 12 is D.R. Horton, even cheaper, $575,000. It's a smoking deal. These are off of the Southern Parkway. This one is not for sale. Somebody's got it. It's 2,400 square feet. Number 12 with D.R. Horton. D.R. Horton is a large national builder that's publicly traded. You can look the information up about them. Richardson Homes has number 13 available for, well, I don't know if it's available. It's $2.4 million. And it is sold. 5,000 square feet. Number 14 is $1.85 million, $1,850,000, with what looks like a green front. It's for sale, 4,300 square feet. Looks like a ship. Number 15 is $3,999,999 in Hurricane, and it is not for sale. 6,490 square feet.
Yeah, under $4 million.
Yeah, somebody give him $1. Put that up at $4 million. Number 16 is your friends at Interstate.
Yeah.
2.4 million. It is for sale. 3,200 square feet. Number 17. $5 million even. It is for sale. 6,500 square feet. $5 million house. It's in Hurricane also. Anybody that says Hurricane's a bad neighborhood hadn't looked at this $5 million house.
Dixon Springs is
Number 18, they named this the Madhouse for some reason. I live in a madhouse. I'm not sure they ought to do that. And that's your friend Madsen. $3,999,000. It is for sale. 8,711 square feet. That is a big house. Number 19, $1,400,000 for sale, 2,500 square feet. That was number 19.
Yeah.
Number 20 is Perry Homes, $1,595,000. Looks like it's a duplex. It's for sale, 3,300 square feet. Might be on a golf course somewhere. Number 21 is $3,750,000. It is for sale, 5,500 square feet. Number 22 is $1,900,000. This is on, it's for sale, 4,700 square feet. This is on the Ledges Golf Course. Um, 23, $1,650,000, not for sale, 2,500 square feet. Almost, we're getting to the end of the run here. We are Ince Homes, another house under $1 million. This is the third one so far. It is $969,900. It is for sale, 2,300 square feet by Ince. And then we are now at number 25 in Sun River, under $1 million. It's $699,900. It is for sale if you're over 55 years old. No young people in that neighborhood. It's 1,850 square feet, $699,900. Then we have number 26, $5,999,999. So we'll call that $6 million house. And it's for sale. It's 8,884 square feet. Probably ought to see that one. It's a big one. We are number 27, $4.8 million. It's called Belle of the Beach, so this is going to be down off of I-15 at exit 2. It is not for sale. Somebody stepped up and bought that $4.8 million house, 7,600 square feet. Room for the family. And number 28 is a Cole West home for $1,900,000. It is for sale, 3,800 square feet. That's $1,900,000. And number 29 is AJ Construction, $1,300,000. It is for sale, 2,700 square feet. Almost done. Number 30 is under $1 million, called this by Visionary Homes, $950,000. It's not a lot under $1 million. You probably could offer it's for sale. You probably could offer to buy the furniture and get it over $1 million if you wanted to. And then finally, going into it, we knew there'd be one. Number 31 is built by the Washington County School District for $502,000, which is also kind of funny. We think of that as a low-cost house in St. George because $500,000 is not a cheap house. That's 1,700 square feet, but it is for sale. So what I want to know, and we're going to call it a day. This is not an advertisement for the Parade of Homes. I don't know what it costs. You can go to the mall at the center court in the mall. You can buy a ticket and get a magazine that's got that information on it. There's an app you can get on your phone to go visit any of these houses that you want to see. Their rule is you can only visit them once. There's one house you can pick out and go to it a second time if you want to do that. They just do that to try to hold foot traffic down. If you haven't gone to the Parade of Homes before, this is a chance for you to see a whole bunch of houses that are over $1 million, substantially over $1 million, and just see how the rest of the world lives if they're on the top of the heap. And I don't know why you might go to do it. It's good, interesting for decorating ideas. It's interesting to kind of see what the trends are. We saw gray at the Parade of Homes before the rest of us put gray in our house. You can see what the color is. You can see the cabinets at one time, doors weren't opening this way, they were opening this way, and we did that for a minute, and we looked at that, and you look at, do we have showers for 4 people or what, kind of thing. There's trends that you'll see. It's just kind of a fun day if you like that kind of thing. It's not a sales pitch for that. My question is this. Most of these people decided they were going to build a parade house. They've built them in previous years, of course. Many of them have. Some have not. You have to get points accumulated in order to qualify with the home builders in order to build one of those houses. The 30 builders that qualified. It's interesting. They all made this decision at least 6 months ago. Now think about the economy 6 months ago. Was it different from a real estate perspective than we think it is now? For one thing, Joe Biden hadn't raised the interest rates yet. So people could qualify for a price at a house that is a given price, and if interest rates goes up, which they've doubled, then you qualify for less house with the same amount of income. So that has an impact. Tally up what you wrote down. How many of these 31 houses are under $1 million? Did we get 4? You got 6? Under $1 million.
I only have 4.
4 or 5 or 6. Most of them are more, right?
No, there's 6. Sorry, there is 6.
So 6 houses are under $1 million out of 31. That is 1 out of 5 is under $1 million. 4 out of 5 are over. That's kind of staggering to think about that. Only a couple of those houses are in gated communities. They're all in nice neighborhoods. And that might expand our mind a little bit about what nice neighborhoods are, where they are. We've got preconceived ideas to some extent about areas that we wouldn't want to live. And then we find over on that side of town, there's some pretty awesome houses. And so maybe we should rethink our maps in our mind, possibly. How many are spec houses? That's the number that I'm really interested in.
Well, there's only 6 that are sold, so.
Well, there you go. 6 are sold. Let's do the backwards math. 25 of those houses are
8 of them are sold.
8 are sold. That's an unbelievable number to me. All of those people are betting on the market holding up to be able to sell those houses. Now, interest rates are a factor for some because they are putting money down and financing some. In this price range, more people pay cash than you would expect. I don't know where they get the cash from, but they're drug dealers or something. I don't know, YouTubers. Last year, 2 years ago, there were 2 of the houses that had YouTube studios in them. They had made their money from YouTubing, which is always kind of interesting to me. That's a new career that didn't exist a few years ago. And you can make a lot of money doing that. And we have some people that are buying houses with cash that are doing that kind of thing. We have people that have sold out on a house that their grandma bought in California and sold it for some stupidly high number, and they have cash to come into our market and buy a house for cash. But everybody is affected by something, interest rates or the stock market, or the overall market itself. So as the market changes, then our real estate market changes as well. And if you follow Zillow, you can see that nationally we've got a softening of the value of price of houses in America. Now, St. George has resisted that to an extent because we are a desirable destination for Salt Lake people that either want to retire or want to have a second home. And so that helps us out, and it has helped us out for years. But the question that we want to follow is, how many of these business people, there were several of you in this class that wanted to be contractors at some point in time and build a construction company. Here's where the acid meets, no, it's the acid test, where the rubber meets the road. That's what I started. I twisted two weird statements there. This is where, do we take a risk? How many of these houses will still be on the market next year for the Parade of Homes? They won't have ever sold, or they'll have to reconfigure what they wanted for them, convert them into a VRBO. Some of them are big enough to convert into apartment buildings, I think. I doubt that they will do that, but this will be an interesting thing for us to watch. Some will sell during the Parade of Homes. People will walk in and go, well, I got to live here. And they've got the means, they will do that kind of a deal. There will be...
that are sold are over 4 million.
That's crazy. I don't know if it's crazy or not. It's good for them. I guess good for... This, as we look at data, that's why we're talking about this. This is real data. Some of us will go visit over the weekend. It's a long weekend, by the way, for some people. It's a 3-day weekend, and so we'll have an inordinate amount of traffic in town. I wished everybody just went to the NBA All-Star games up in Salt Lake and stayed out of here. But this is what drives our economic engine to some extent. Events that are from drawing people from out of the area. And investing in our real estate is a good thing. For every multi-million-dollar house that's here, there are a lot of support businesses that benefit from that. The builders themselves, of course, but you've got ongoing cost of landscaping. These guys with the $6 million houses aren't cutting their own lawns. You know, they're buying services. And, you know, some of them have $200,000 budget for the televisions in their place. You know, there's some pretty staggering things that you'll see when you walk around, how the wealthy, and I think people with that, while in Miami they may not be the rich people, but in our neighborhood that's the rich people that are buying these homes and living in the homes. It's just interesting to see what their choices are. And if you've got input after you've visited, if the next couple of classes we can have a comment or two if it's appropriate to what we're talking about. But my specific focus is the risk it takes to go to the bank and borrow enough money to build a $5 million house and pray that you sell it. Because if you don't, who's making the payments from the bank? The builder. The builder owns that property. And we've got 25 builders that are holding the bag with multi-million-dollar properties that they may or may not sell. So it's interesting. This is an interesting case study for us to kind of watch. And would you take that risk, or would you not? You know, I noticed the Richardson Brothers house was sold. It has been sold for the last few Parade of Homes. They went into financial crisis as their own admission some years back, and pretty close to hit a wall. But to save the business, they decided to manage their business differently. And so they're, as a company, they're less willing to build on spec, because what happens if it doesn't sell? Are we prepared for that? And that's true if our business is building houses. That's true if our business is putting awnings in, building wall beds. It's the same dynamics, right? Do we build stuff that's not sold yet, or do we figure out how to build it fast when it does sell? You know, and we were talking about Cabinet Tech in years before Cabinet Tech. Don had ways of building houses in 30 days. And he built a lot of them in 30 days, so he didn't have to pay his vendor until he sold the house. So he's operating on somebody else's cash. That's brilliant. But you got to really have your act together to do that. because you slip 1 day, 2 days, 3 days, you have flipping Las Vegas and that guy's going ape, right? Because you cost me 3 days. Well, time is money, right? And so we're going to see that here at the Parade of Homes as well. Talked enough. Have a great weekend. Be safe if you go see the parade. Enjoy it. Report back. Let us know what your favorite stuff was if you want to. But whatever you do, have a great weekend. We'll see you on Tuesday.